We're still in a conflict with Iran, and all of these things do affect the global market and the real estate markets, right?
That's 100% right. I Warren Buffett talks about this where he says that real estate developers, they're only limited by the financing that they can get. So if lenders out there will do whatever and they'll make all kinds of silly loans, there's always going to be a developer that's going to take that money, even if it's going to lead to them going.
I would like to take a 10-minute break and then three, two, one.
How do you have the ability to analyze stocks? Welcome to the Generations of Wealth podcast. I'm your host, Derek Dombeck. Today's show, we are going to chat with a gentleman named Will Harvey, and Will is, he's been in the business for a while, but it's interesting to see how he progressed. And his story is really cool. Ultimately, college dropout, which he'll tell you about, and got into being a lender and also putting together his own fund and doing some real estate deals. So before that, you're going to hear in the show we talk about raising money, we talk about syndications. You know, I want to be a resource of yours. I raise money for my projects. If you need help in learning how to do that or connections with people, feel free to reach out to me. If you want to talk to me about investing in some of our projects, reach out to me. So derekdombeck.com and or thegenerationsofwealth.com. Let us help you. That's what this is all about. With that said, let's bring on our guest. And here he is, all the way from the east side of the country in Richmond, Virginia, Mr. Will Harvey. Thank you so much for being on the Generations of Wealth show.
Yeah, thanks so much for having me, Derek. I'm honored to be here.
Well, first of all, I know that you've got some lending experience and you kind of got into real estate pre-COVID. But before we dive into any of that, why don't you just tell the audience a little bit about yourself and your background?
Yeah, absolutely. So I'm a double college dropout. So the first time I dropped out was to get sober. I was going to the University of South Carolina and had a little bit too much fun there. So I came home, got sober, and then I ended up walking on and playing football at a small school in Ohio for a short while until I had double hip surgery, and that was the end of that, and I dropped out again. And I sort of flirted around with finishing my degree and going to a local school in Northern Virginia where I lived, and but I ultimately ended up going the career route. I had a family friend that ran a mortgage company, and he offered me a position where I would basically come on as a loan officer assistant for about a year, and then I would jump out and be a loan originator myself. So that was appealing because um, I didn't have any expenses, so I could go 100% commission and be just fine. And the thought of a fixed salary was just not really didn't entice me at all. So, I wanted to have an uncapped ceiling and be able to go in and have my effort produce whatever the output would be. So that's why being 100% commission was interesting to me. So I started doing that and launched in late 2016 as a loan officer, and it was great. I had a great run and bought some rental properties during that time. I realized I hated being a landlord, but I got to three houses and in an expensive, Northern Virginia area, and just I was running out of money. And every time I would buy one, I would basically drain my bank account. I was using only my own money, and it was good. It was fine to own rental properties. I knew I was building wealth, but I wasn't, like I said, I would drain my bank account every time I bought one, and then also the headaches that come along with being a landlord were just not for me, I realized. So I shifted my focus in early 2018. I started learning about apartments, and
Mhm.
apartment syndications. And that's what I dove into that, got involved with a few in 2019. And, from then for the next 5 or so years, I invested passively in various apartment syndications. And that went well. And at the same time, I was flipping houses, and that was a cool strategy. What I was doing was I was flipping houses. This is after I left the mortgage business in late 2019. I started a house flipping company, and I was doing that. And the income that I would generate from flipping houses, I could offset with the bonus depreciation that I would get from these apartment deals that I would invest in. So because I was a full-time real estate investor, I could use those passive losses against my active income. And house flipping, you're taxed as ordinary income, so there's no preferential treatment for that. So that was a great thing. And I did that for years, and all the while, I just realized that I like being on the finance side a lot more than being on the operator side. I did a couple more. We actually still own them with partners, a boutique hotel and a wedding venue. And I'm a more of a capital partner on those, but I still am a general partner. And I just realized through that and through flipping and everything else that I'm better situated on the finance side of things as opposed to the operations. So in 2023, I started a fund, a friends and family fund, where we pooled some money. A lot of the fund is my own money. And we started, I'm the general partner of it, and I basically was tasked with going out and trying to find interesting real estate projects to invest in. And that's been good. And the hard money thing came about through that. I had someone approach me, and it was totally accidental. And we ended up just having some cash sitting on the sidelines, and we did a hard money loan, and it was great. And started doing more and more of those. And then last year I started a dedicated fund for specifically hard money, and that's where a lot of my time goes towards now.
Okay, well, I have a couple things. First of all, you don't know this about me, but I co-owned a hard money lending company for 10 years.
No,
So
no
we
kidding.
we can definitely jam on that topic. But my first question is, you said you walked on and played football for a small school. I didn't really realize that the Buckeyes were a small school.
It wasn't that school. We were I would always joke that we were overshadowed by a school that was a little bit bigger than us,
Well,
being
you
the
know,
Buckeyes.
we're in Wisconsin, where I'm from. It's all Badger Nation around here. So,
Yeah, right.
yeah. And my mom's boyfriend lives in Ohio and is an incredibly huge Buckeyes fan. So
Oh,
I
right
throw
on.
jabs anywhere I can.
That's funny.
So, but well, okay. So let's kind of go back to the beginning. With the residential, I think it was residential lending, right? When you first got
Correct.
into it. So was that just owner occupant loans and just basically a mortgage originator for a mortgage broker?
Yeah, a mortgage company. It was Fairway Independent
Oh,
Mortgage.
okay.
They're in all 50 states. They're a big lender. I think they're actually based in Wisconsin.
Yep.
But yeah, they um, conventional FHA, VA, that was the bread and butter. There were a few programs outside of that, a few jumbo programs, and I did a few investor loans. You can buy a rental property with a conventional loan, but for the most part, yeah, it was all just primary residence, FHA, VA, conventional. That was really the what I was doing.
So what did you learn from that experience as you stumbled into, I'll say, the hard money lending side of things?
Yeah, I learned from that just about underwriting and how traditional lenders, they look at, they're more underwriting someone's ability to repay and their income. And they're not, you know, obviously they do appraisals and they want to know that the collateral is worth what whatever the loan amount is. They want to make sure that everything checks out there. But they're way more focused on the borrower. Whereas in hard money lending, it's sort of flipped where most of the focus is on the asset. Hard money lending is asset-based lending.
Mhm.
And there is focus on the borrower, but it's mainly just making sure that that project and that and that property that there's a good enough buffer between the loan amount and whatever the ARV is or the as is value to make yourself whole if God forbid you have to foreclose on someone. So that's sort of the difference between what I was doing there versus what I'm doing now with hard money. But I will say that based on my experience being a loan officer, I put a ton of emphasis, probably more than most, on the borrower and their character, their credit, and all of that.
Well, and I've had some other lenders on the show over the period of the last 2+ years that we've been doing this, and I love having these conversations because first of all, you as a lender, you're underwriting to protect the borrower, even though they don't necessarily see it that way. But as you're listening to this show, your lender is your partner in a manner of speaking, and if your lender is telling you, hey, this doesn't look right or smell right, I need more data, it's because we want to know that you actually did the research or you're planning for the what ifs, because that's what underwriting is all about. It's looking for all of the potential failures, and we all want success, but we also know better. There's so many things that can change, just market cycles and economies. And currently, as we're recording this, we're still in a conflict with Iran, and all of these things do affect the global market and the real estate markets, right?
That's 100% right. I Warren Buffett talks about this where he says that real estate developers, they're only limited by the financing that they can get. So if lenders out there will do whatever and they'll make all kinds of silly loans, that's not there's always going to be a developer that's going to take that money, even if it's going to lead to them going bankrupt. Real estate is going to get developed based on the amount of financing that's available. So, like you said, we're protecting. Yeah, obviously, I'm first and foremost wanting to protect our investors, the ones in our fund, and that's who I'm looking out for. I'm a fiduciary, and that's who I'm looking out for first and foremost. But it does us no good if our borrowers aren't successful either. So obviously, we want them to make a ton of money and us do good loans and get repaid, and they go out and make a lot of money and then keep coming back to us for more loans. So we're definitely in the business of financing and not owning real estate. So we don't want to take back any properties.
No, and as a lender, the best thing you can have is a great relationship with a borrower that comes back time and time again, and you're both
Exactly.
making money. I mean,
Yep. That's exactly right.
it's way less underwriting the second, third, fourth time around than the first time.
Yeah, exactly. I mean, I have guys I work with a lot, and there's very little, it's as smooth as it gets. It's like, hey, I need this money, and I wouldn't say they have a blank check. I'm obviously going to look at their deal, but it's a whole lot less onerous than someone that I've never worked with before.
So you haven't been lending a real long time. Have you gotten any negative or horror stories so far?
We've done 30 loans and we've had one technical default that was cleared up pretty quickly and it's been paid off and we're fine now. So everything's current and it's only a matter of time. It's not if
Oh
you
yeah.
lend long enough, you're gonna have defaults, you're gonna have foreclosures, and I'm fully aware of that. And I feel like I have a good plan in place to deal with that. But no, I mean across the 30 we just haven't been doing this long enough. So
Mhm.
but I am 100% aware that it will happen. It's just a matter of when. And I feel like we're in a pretty good spot to handle it when it does happen.
So what are the terms of your, I'll use the word typical, but maybe they're not typical. What's the terms of your loans?
Yeah, our typical product is a 9-month loan. We have a couple extensions baked into the note for a fee, but it's a 9-month term, and the interest rate is 12%. And we collect 3 origination points up front, and we charge a flat $700. Probably going to be raising that soon, but a $700 doc prep fee.
Okay. And as far as loan to value, where do you go with that?
Yeah, we won't do. I have a hard, absolute firm hard stop at 70% of ARV. So I was originally a little bit higher than that at 75, but recently I've just seen in our, real estate is so localized, and I don't pay a ton of attention to. I would say I skim the national data, but really, we operate in Central Virginia, and that's where I'm focused. So national data could be completely different from our local market here. So that's what I really look at. And what I'm seeing are things have softened a little bit. And I've gone to some, I've talked to other hard money lenders, and they're just talking about having more loans with extensions, and so I'm taking all those factors into play, and I just decided to cut our exposure a little bit and trim it down to, 70%. So 70% of ARV is what we'll do. And then, as far as loan to cost, we'll do 100%. If it's a phenomenal deal, we'll do 100% less our points and fees. But it's got to be a really experienced borrower and an absolutely, phenomenal deal for us to do that. Usually we want to have some kind of skin in the game.
Yeah. In monthly interest payments, I'm assuming.
Yeah.
Yep.
Yeah.
Okay.
Monthly, just interest only.
Yeah.
What
So
about you? What were you, tell me about what you were charging. What was your typical stuff?
enough about Will. Let's get back to Derek.
Yeah, exactly.
Well, my regular listeners know a lot of this stuff, but um, we started off. I had a business partner in the lending business, and we started off kind of like you. It wasn't a goal of ours to build up a lending company. Initially, we were just raising private capital for our own deals, and we ended up having more capital available than deals, and we
Mm,
were very. I still am, but we at that time we were very heavily involved in all of our local RIA groups. We were leading our own. We were speaking at other RIA groups, and so we just, we had people that were looking for money that had good deals. We wanted to keep our investors' money going, so we started, the arbitrage model, and that led to a fund, and then that led to a co-funding partner, and we were. I would say between COVID starting, that's really when we escalated quickly because the national hard money lending companies got shut down. They were selling their paper on Wall Street and nobody was buying it.
right.
So we were averaging 20 to 25 loans a month, and
Wow.
which was about three and a half, roughly $3.5 million a month. Um, and 12 and 3 in most of the state of Wisconsin. Milwaukee was 13 and 4.
Okay.
And it got to be to a point where more volume wasn't necessarily better, because it's also more paperwork, more overhead, more staff, um, keeping an eye on the projects, hiring people to go do walkthrough inspections, and trusting those people, even when some of them weren't trustworthy, right? Like,
Right.
we definitely have horror stories that we learned from. And in the end, I've been out of it for a little over 2 years now, just for reasons that were more vision based, as far as where my former partner and I had visions for our companies and our personal lives. Kind of took a Y, and we were together, and
Yeah.
we ventured off.
Yeah, that stuff happens.
But when we saw a change in our lending as far as we had a very low default rate. Our default rate started to tick up when the interest rates changed and
Mm,
started getting above 5% because a lot of our borrowers were borrowing money from us to fix up rental properties and then refinance the rental properties,
mm,
except they weren't doing really good rehabs. So when they couldn't get refinanced or they could but it wouldn't cash flow, then they thought, "Oh, we'll just sell them." Except they didn't sell at the prices they thought they should sell for because they did, quite honestly, they did shit rehabs thinking they were just going to be for tenants, you know. But
yeah,
they wanted to use comps as if did a really nice rehab, and it just doesn't work that way.
right.
So we ended up, starting to have to take some properties back. And for us, it wasn't a big deal because we also ran a full-time, renovation and flipping company. And so if we had to take it back, we just went in, did what we had to do and get it gone.
Yeah,
But definitely a lot of lessons from that 10-year run
yeah,
as
it
far
sounds like
as
it.
lending, but also what I see, and I see it at our local level, and I see it on a national level, because I do coach people from all over the country in creative deal structuring. It's when people get involved in lending, like you as the borrower should do everything you possibly can to protect that lender, to protect that investor of yours. And I see people doing loans, just one-off loans, and they're not underwriting, they're not getting proper paperwork put in place, proper insurance put in place, lender's title insurance, all those types of things,
Right.
you know. And
Yeah.
and if that's the lesson that everybody gets from our show here today, Will, um, it's if you're the lender, you need to underwrite properly, and if you're the borrower, you should want to protect your investor, your lender. And I'll give you one quick story that happened quite a few years ago, but this younger couple had just gotten into real estate and their uncle was willing to give them a loan at like 2% interest. It was ridiculous, which was awesome for them,
Yeah.
but they did not give him collateral. It was just a signature loan. And they're like, "Well, he's fine. He doesn't care. He knows we're good for it." And I said to them, I said, "Okay, what happens if you die? How are you going to repay him? He has no collateral, no mortgage against the actual property that is the asset. You're setting him up to fail.
Right.
He should have a mortgage against that property, first of all, so he can recover his money. Second of all, that's asset protection for you, the young couple doing this in this flip. If you get sued and you have a free and clear property, you're going to lose it if you lose the
Right.
lawsuit, and your uncle's going to be out, right?"
Yeah. So
So,
that just comes from inexperience, right? On both ends.
right,
Yeah.
absolutely.
Yeah. Wow. Well, if I could get 2% money, I would do everything I can to keep that relationship going and keep him happy.
Well, I'm not telling anybody they shouldn't use family money, but
Yeah.
you should treat family money the same as you would a stranger's money.
Yeah, I agree. I agree. When I was flipping, I had a similar situation. My dad, he certainly didn't give us 2% money, but he sold his business in 2021 and was, just had a good amount of cash sitting on the sidelines and needed to find a place to make it start working a little bit. And I don't the listeners 2021 was, rates were just zero. So you couldn't get T-bills were paying next to nothing. And we offered him, you know, we were getting hard money at 2 and 10. And we said to him, and he sold his insurance agency with a few other guys, and we offered them something like 1 and 8 or 1 and 9. And it worked great for both sides because for them, they were earning almost a double digit return. And you couldn't sniff that in the market anywhere unless you were going after junk bonds or something like that.
Mhm.
And then on our end, it was great because we got, cheaper money. It allowed us to be more competitive and helped our bottom line. And yeah, we set everything up as, first lien deeds of trust. And I did it as if we were dealing with, you know, someone that I didn't know, like an institutional lender. It was all set up that way. And yeah, I totally agree with what you're saying and strongly, encourage everyone to do the same thing and don't, don't just do it willy-nilly, handshake deals. Use deeds of trust, mortgages, do all that to protect yourself and the lender.
And know your foreclosure laws, right? Every state's different,
Yeah.
but you know, where I live, commercial foreclosure laws are different than residential foreclosure laws. We
Mm,
would never do a owner occupied loan when we were hard money lenders. And I had people approach me for that, and instead I would buy their property and then give them a lease option to buy their property back from me
mm,
if it was owner occupied. And I've done that a number of times when we were lenders, but I still do that to this day as an investor. Um, but that way it's not a loan and we have the deed already. And so
right.
if they fail, which is not the goal, but if they fail, we don't have to foreclose. They had their
Yeah,
chance.
that's interesting.
Um, but let's kind of jump into the fund. Like, what got you into deciding that you want to put together a fund? How scary was that? And I've interviewed quite a few syndicators on the show as well, but most of them have been established. Some of them are doing, huge, huge, huge volume. But you know, what led you to want to start a fund?
I like the fund model. I've been in one-off deals, and I think when you own things, you know, at the fund level, and then the fund owns different assets, there's a diversification element that you don't get when you just do a single real estate deal.
Mhm.
So when you do a one-off deal, all your eggs are in that one basket. Whereas if you owned 10 deals through a fund, you're spreading your risk out. And if one of the deals starts to stumble, the other one should smooth out the returns because they continue to, to uh, operate and move along nicely. So I liked that element of it. Our wedding venue, when I told you that we bought that, that was one where we did a standalone deal, and it was tough to get it going, and required more capital than we originally raised. And you know, praise the Lord, I was in a position where I ended up putting in some more money. I didn't have to go out and call it from investors, which was good. But just going through that really reinforced in my mind that I like a diversified model where, where one deal is not going to be the end of the world if it doesn't go according to plan. So that was a big motivation for doing it that way. And I should say that the funds that I have they're more friends and family, smaller funds. I'm in the process of working with an attorney, and he's drafting all the docs for a 506c fund that I'm going to use for the hard money lending. But that's not I have not launched that yet.
Mhm.
So I just want to make sure you're aware that these funds are not huge. Now that one I do intend to really scale it. I feel like we have a good proof of concept, but for right now the funds are, more in the friends and family realm.
Well, and just for clarity for everybody else, basically a friends and family fund, you can't openly advertise. You have to have a relationship with the
Exactly.
people that you're raising from, or as you meet them, establish a relationship before they can invest with you, versus the 506c where you can put an ad out there on social media or send emails or help put up a billboard, whatever you want.
Yeah,
But then the investors have to be accredited, and
that's
you have
right.
to prove that they're accredited in order to raise money from them. So
That's exactly right.
so the fund model for syndicating apartments versus a fund model for running a hard money lending company out of is also different. Can you kind of touch on that, Will?
Yeah. So when you're like for our fund, the principles are still the same.
Hmm.
When we run our hard money fund right now in that friends and family fund, we have about, I think 15 loans. So I know some guys that do co-lending where they will find a money partner, and basically the money partner will put up all the funds for a single loan. The money partner will get a fixed interest rate, usually around 10%, and then the hard money lender will keep the interest spread. You know, if they're doing a loan at 12% and only paying the investor 10, then there's a 2% spread there. And then they also keep the fees and the points. So that's a popular model. But again, that one loan is what they're investing in.
Hmm.
And they don't, you know, if that one loan goes bad, their return goes from 100% to zero, or their, you know, percentage of performance goes from 100% down to zero. Whereas when you own it through a fund, when you own a bunch of loans through a fund, you're diversified. And the ones that you know, if one defaults of our 15, we have 14 others that should smooth things out. So that's the same principles apply for that, which I like. And to touch on your question about, I'm not super familiar with the fund model for syndications. I'm familiar with the fund model for how I
Hmm.
run my separate real estate fund, that the friends and family one. But um, I have a pretty broad I have a pretty broad um, universe as far as what I'm allowed to invest in. So we've actually recently in the last 2 years, started investing in publicly traded real estate companies, and you know that's gone really well. And so the difference between the hard money fund and this, you know, other real estate fund, I hope this answers your question, is that um, the real estate fund just kind of owns a diversified mix of things. We actually own some hard money notes through that. We own some positions in publicly traded real estate companies, and then we also are limited partners in a few syndications. So there's a few different, you know, it's more broadly diversified than the hard money lending fund, which is only specific to hard money lending. So if you're someone that um, you're like, hey, I don't really like all that stuff. I don't understand the public market stuff, but hey, I like hard money lending, you know, notes backed by first lien deeds of trust in a specific market. That's something I can wrap my head around a lot more. And, you know, that's something I'm more interested in. That just people have different things they understand, and yeah, so I think that is I think that's the difference between them.
Well, and you just said something that's really key that I don't want to gloss over, and that's position. Because so many syndications, including a lot of people I've interviewed on this show, are in a junior position or a second or third position behind a conventional lender or a commercial, lender. And who gets wiped out when there's a shift in the markets? It's the fund or the
Yeah, that's right.
syndication potentially, right? So same thing with our hard money fund that we had. Um, Everything was in first position, and we didn't have any institutional money. Currently, and as this show airs, my syndication will probably be up and running, but I'm working on a syndication to put together with another guy that's redeveloping a resort. And basically, it's going to wipe out all of the 75 plus year old cabins that are on this waterfront resort and build condos.
Hmm.
And but we're not doing any institutional financing on it. So the fund is going to be in 100% in first position on the whole project.
Nice.
And to me, we're going to give a preferred rate of return, and then a split of the net profits. So the investors, they know their baseline, which is the pref, and then we get to share based on the performance of the whole project. But we don't have some institution, and this isn't a dig on you when you were working for a mortgage brokerage, but you know, I'd rather deal with people than big institutions, right? Like we can have conversations about what's going well, what's not going well, and we don't have some pencil pusher telling us what we need to do or should do or what they think,
Yeah.
right?
No, I get it. There's a reason I'm not in the mortgage business anymore. It was
Right.
a lot to do with that. And I don't think people realize how, um, after being in this for a while, I see the value in what you're doing and how, um, that's just a much better structure where there's no debt risk, really. There's no first lien lender sitting in front of you at 60 to 70% of the capital stack where, if something bad happens, they're going to eat first and you might get completely wiped out. If you guys are owning everything just 100%, so that there's just no debt on it.
It's 100%, it'll be 100% investor raised. So,
That's
so
amazing.
no.
And you're still able to hit whatever returns that people need.
Well, and that's the interesting part, right? Like, and I can't talk about it on the show because the
Yeah.
syndication's not done. But the reality is, yes, we will make less profit as the general partners, but I believe in relationships above all else. And I would
Mm,
rather put more money in my investors' pockets than the bank taking it because the bank may or may not want to do another deal in the future. My investors, you know, we want to keep moving forward and keep doing additional deals with anybody
yeah.
that we work with and have for years. So I
I
would,
love that.
that's my philosophy, and has been primarily because, as my regular listeners know, I got my ass kicked when the markets crashed in '07. And it's because I used all institutional debt and I had zero control when the markets crashed. The
Yep.
lenders didn't, not only did they not want to talk to me, they didn't even know what I was talking about because everybody I had done the original loans with, they were out of the business. They were gone. Those
Mm,
banks were shut down, mortgage brokerages. There was nobody to talk to.
right.
Versus you mentioned you had invested in some funds passively. Well, the general partner of those funds, they could call you up and say, "Hey, Will, here's what we're seeing. These, like in my project that I'm working on. Okay, what happens if these new construction condos don't sell? Well, we can pivot. We can lease them out
Right.
for a year or two or three. But I could come to you, Will, as my investor. Hey, here's what we're seeing. The market flattened. Interest rates did what they did. Whatever it is, we're going to lease them out for 24 months, and then when the market rebounds, sell them off. And we
Yeah.
can all have that conversation. We can't do that with an institution that's got a 3-year call on the note or
Right.
whatever the call provision is. You
Yeah.
know,
Yeah.
I shouldn't say
That's
you can't. You can try. It's not
right.
nearly as likely to come to fruition.
Yeah, no, you're if you're getting, Fannie Freddie, that's a popular source of financing in the apartment world, and it's their way or the highway. I mean, they
Mhm.
make the rules. So it's yeah, there's a ton of value in what you're doing and to be able to sleep at night and not have to worry about the debt. I mean, that is a beautiful thing.
Well, and what's my worst case scenario? My worst case scenario is the investors, they get their capital back and I make zero, but I did right by the investors,
Yeah, amen.
you
That's
know, and that's what it's all about because, you started your career in 2016. So you've seen a shift in the market the last couple of years, but I've been through at least two different, very different market cycles and arguably three already in my 23-year career. So it's going to happen
yeah,
again. And the awesome thing is, as you see more markets, or even if you haven't lived through them, you study them and you listen to shows like this and
exactly.
talk to people like Will and myself and others. and be open to it and say, here's my pet peeve, Will, is people that think their shit doesn't stink and nothing's ever going to change, right? I'm just killing it, whether I'm wholesaling or I'm flipping or I'm landlord or whatever genre of real estate you're in,
Yeah.
it's going to change. And that's not bad. We need a thinning of the herd.
That's
Otherwise,
right.
we would just have rampant inflation and everybody would get priced out. So,
Yeah, that's exactly right. If you read my annual letters for my they're on my site. If you read my annual letters for that original fund I started in 23, starting back then, I'm like, man, the market is so overheated and everything is going to cool. We're bracing for impact, and we just want to do everything we can to have minimal debt. And I sound like a broken record because every I give updates every 6 months, and I keep talking about it, and I still feel that way. We've seen a little bit of a dip in the market, in the stock market, pertaining to, I think, mainly this conflict in Iran. But everything is still so overheated in my opinion. And yeah, I think that studying what other people are doing, studying history, studying the different crashes, whether it's the dot-com crash, the '08 crash, or just different cycles. Recently with interest rates doing what they did, starting in 2022, there's been a lot of fallout in the real estate space, and I've seen that in looking at hundreds and hundreds of publicly traded, REITs and different corporations that own real estate. You really can see a lot of what's going on the ground from doing that, and it informs you that yeah, I need to take a position of humility here. I need to be humble in all my assumptions, all my assessments. You know, I think that, yeah, there's a guy that I know, and he taught me many years ago about, what was it called? A bull market genius. A bull market genius is someone who, in a bull market, everything is going up, a rising tide lifts all boats. So they feel really smart, and they get reinforced that,
mhm.
what they're doing, buying, crappy, fart coin. Remember that?
Yep.
Remember
Yep.
that one? So
Yep.
people making crazy money on these silly meme coins. That's just an example. But, you know, if you buy something and then it doubles, you feel really smart. But that's not, you do that enough, you're gonna go bankrupt. I mean, it's just not gonna be, that's not a lasting strategy to build wealth.
And the interesting part is, and I'm speaking from experience, you know, you can have a great run of several years and everything is just hitting perfect. And you start saying, I'm going to go bigger, bigger, bigger. And one big deal can wipe out 5 years of medium-sized deals or small deals,
That's exactly right.
and that's just being humble and taking the time, like you said, educate yourself, study these markets, listen to podcasts or wherever. But the other side of that is there's so much information available now that wasn't there when I started in this business. And what do you believe? Because anybody with a microphone or just hell a camera phone can be an expert in their own mind,
Right.
and a certain percentage of the population is going to believe what they say, whether it's true or not. Of course, what we're talking about is 100% factual and true, so everyone should listen to you and I will. But that's just the reality of where the times we live in now.
Yeah.
And YouTube University is scary, especially when it comes to things about asset protection and entity structuring and taxation and things like that, because people they'll search it on YouTube, they'll listen to a couple videos and oh, I'm not going to spend money on that type of LLC or that type of trust or whatever because Bob Smith said I shouldn't,
Right.
versus you know Joe Miller saying I should. It's a little daunting and a little scary in the times we're in, honestly.
Absolutely.
And then
Yeah.
AI, right? Everybody just goes and asks Chat or Gronk or whatever, what should I do? And I'm gonna believe AI because why would AI be wrong? You
Right.
know,
Yeah.
but AI
They should
hasn't
look
lived
up
through
what
market
hallucinate
cycles.
means. Exactly.
Yeah, awesome.
Yeah.
Well, I got a hard question. My regulars know it's coming. What is one question I should have asked you that I did not? And it can be about anything.
Um, Man, that is a hard question. Let me think for a minute. Um, I would say when I mentioned Warren Buffett, you should have dug in more on that. I think that I think that studying Warren Buffett is so I've read all his annual letters, and anytime I'm asked what my favorite book is, I
Mhm.
just point to his annual letters and I say, hey, it's kind of a book. If you put it all together, it's a book.
Hmm.
But study Warren Buffett's annual letters. He started writing them, I believe, in 1957. When this is pre Berkshire Hathaway. This is when he ran his first investment partnership. He ran it for about 12 years, and then he dove more into Berkshire Hathaway. But those early partnership letters can be found online, and then all of his letters that he wrote as chairman of Berkshire Hathaway, those can be found on Berkshire Hathaway's website. Um, and it is just absolutely loaded with wisdom, with practical, just it's arguably the greatest investor to ever walk the face of the earth. And he is just so giving with his knowledge and his experiences and just how he thinks. And it is just something that I think I think if more people read that, we would have a lot better investors out there. And it doesn't matter what field you're in. He has done all kinds of stuff. He's owned candy companies to, insurance and Geico and all he owns I mean Berkshire owns tons of different things, but all his principles and his philosophy applies to really anything, whether it's real estate or something else. It's just really, really good. So I would have dug into that a little bit more, and Warren Buffett is someone that I would study if you haven't already.
Good answer to a great question that I should have asked. There you go. Well, Will, with that, I think we're going to wrap up the show. Appreciate your time and your knowledge and just being willing to share your story with us.
Yeah, I really appreciate you having me on.
Absolutely. For everybody else, take what you learned because everything you hear on the Generations of Wealth is 100% true. You don't have to go to YouTube University unless it's my YouTube channel. And with that, till the next show, go out, live your vision, and love your life. See ya.